And China's growth figures in focus this hour against the backdrop of the Middle East conflict as investors gauge how resilient the world's second largest economy is to rising oil prices and global demand risks. And we've got some breaking figures for you right now with the country's Q1 GDP coming in at 5% year on year. This beats a Bloomberg estimate for a 4.8% growth. It is also better than the previous quarter's growth of 4.5%. That is for the period of October to December. And this comes as GDP growth for the country is expected to slow in the second quarter. We've got other key data points that we're tracking for you this hour as well, with retail sales coming in at 1.7%. That misses Bloomberg estimate for a 2.4% growth. Industrial production, though, did better. That came in at 5.7%, beating estimates for a 5.3% growth. Fixed asset investment missing estimates. It came in at 1.7%. Estimates was for 1.9%. Just a reminder that China's official target for GDP growth this year is 4.5% to 5%. And now we get you a check on markets as investors weigh the economic picture in China, with mainland Chinese markets still trading in the positive, led by Hong Kong's Hang Seng, which is up by about 0.9%. A look at the Chinese yuan this hour as well against the greenback, 6.819 there. And for more, Tan Si-Hui joins us live from Beijing. So, Si-Hui, China's growth coming in above estimates. It's 5% on year. And against this backdrop of the war, I mean, how does this stack up versus Beijing's targets for the year as well as market estimates?
Well, China's economy hitting off on a good start with a 5% increase. And we see the Bureau of Statistics saying that this shows resilience and vitality. Now, let's take a look at the reasons. Well, China's economy is still very much reliant on exports, and this is despite the high U.S. tariffs. Total trade surplus more than $260 billion this year, surging in the first 2 months before shrinking in March due to the Middle East conflict, due to the global outlook demand being affected. But the momentum is very much insulated from higher energy shocks as well as raw material shortage due to supply side diversification. Also a strong innovation push as well as AI investment supporting production growth. And that's why we see March industrial output at 5.7%. That is a very strong result. Green economy also led to industrial upgrading. Oil prices rising also led to overseas demand for Chinese EVs going up. But of course, there are still weak spots. Domestic demand not keeping pace with supply side. March retail sales at 1.7% increase. That is almost a 1 percentage point drop from the first 2 months of 2.8% increase year on year. And so the priority is still to build a strong domestic market as well as a unified national market. Also, property sector still showing signs of weakness. Fixed asset investment at 1.7% increase, but property investment still on the decline.
Yes, Si-Hui, and this war indeed will test Beijing's policy roadmap for the year. What does China have in the pipeline to help the economy withstand the risks from the war as well as fuel growth this year?
Well, the GDP growth target stands at between 4.5 and 5%. But because of what's happening in the Middle East, the IMF has already cut China's GDP growth forecast to 4.4% this year and projecting growth to slow further to 4% in 2027. And that's due to global demand risk as well as domestic consumption weakness. And so this signals that more support is likely. And as we've heard at the 2 sessions in March, Budget deficit is going to be set at around 4% of GDP. Central bank to keep policy accommodative. The focus is shifting towards high quality growth away from speed of growth. Also, at the two sessions, they had unveiled the 15th five-year plan, and that is the roadmap for the next phase of development with a focus on tech, on self-reliance, as well as industrial upgrading. So overall, China is stabilizing in terms of its economy, but the big question is whether domestic demand can keep pace and sustain growth even amidst this Middle East conflict.
All right, Su Hui, appreciate your breaking this down for us. Su Hui Wei reporting for CNA. We go over to speak with Tommy Xia now. He's head of macro research at OCBC Bank. So, Tommy, thanks for joining the conversation now. China's economy rebounding to 5%, but this is, of course, from the three-year low figure of 4.5% from the last quarter. How significant, then, is this latest read for you?
Yeah, good morning. I think this is quite a strong start, I would say, for the new year, right? Because of the uncertainty in the global situation. So if you look at the breakdown, as mentioned by Su Hui, actually, the domestic demand is still not strong enough. One of the key supporting factor looks like it's still the investment for now. In particular, we are seeing the support from the infrastructure investment. So because of the front loading of some of the fiscal policies. For example, if you look at the issuance of the local special government bond. So that was hitting roughly about 1.16 trillion in the first quarter of this year. In terms of the year-on-year growth, we are seeing about 20% year-on-year growth. So those actually translate to the support in terms of the fiscal spending, in terms of the fiscal investment, etc. But what's lagging is still the consumption, still the retail sales. I think there's something I think China still need to work on, how to reboot the domestic demand. That's a big question. I guess it's important for the next few quarters as well.
Yeah. Tommy, Reuters actually suggested that this growth that we're seeing now could actually be the peak for the year for China. The growth, in fact, is expected to cool over the rest of the year because of the Middle East conflict. How vulnerable then is China's growth target of 4.5 to 5% for this year?
Okay. First of all, I think I'm kind of agree with this assessment. In fact, I do expect the GDP growth to moderate from 5% in the first quarter, maybe to around 4.8% in the second quarter. But I don't think there will be a big problem for China to achieve its growth target, right? So I think 4.5 to 5% kind of the range is still very achievable for China, because I think China in general is still quite resilient to this oil shock for now. And in terms of the external demand, export seems like it's still quite supportive. In fact, I do expect that China's trade surplus to uncheck, maybe to reach around the last year's record high level, which is about $1.2 trillion. And investment will continue to play a part. The only thing right now is still very uncertain is the domestic demand and the consumption. I mean, I think China can achieve the growth target, but of course the question is how good the quality of the growth, because the good quality of the growth means you need to have a strong domestic demand. You need to have a strong consumption. So that also goes down to the question about the income growth for the people in China. I think that still remains the question we are still seeing right now.
Yeah, I mean, just to build on that, first we're hearing that China is so far able to absorb the economic shock from the war. But at what point could it start to feed through the economy and really dampen domestic demand, especially as oil hits input costs, squeeze profits, and also on the other side of the argument, what about the reflation side, from the higher energy costs for the whole domestic situation?
Yes, I think that's two questions. I mean, basically, in terms of the impact on the Chinese economy from this oil shock, again, depends on the duration of the war, depends on the duration of the shock. I guess in Asia, nobody can 100% insulate from this shock. But China is in the slightly better position, but that means China can really insulate, because if you look at the energy mix for the Chinese economy, I think we are still close to 30% of the economy is reliant on the oil and gas. So we are seeing some kind of the impact on the petrochemical, for example. So in fact, in March, we already start to see some of the impact, in particular in terms of the capacity utilization in some of the upstream sectors, which is rely on the oil and gas. We are seeing the decline of the capacity utilization. So that's why I think if this situation continue to worsen or last longer, I guess China will be kind of affected. But in the near term, I think China is slightly in the better position for now.
Yeah, and finally, Tommy, the PBOC is expected to keep the LPR steady. Politburo is going to be meeting later this month. Do you think the latest GDP figures give Beijing more room to delay stimulus?
Yes, I think that's possible. It's not only from the stronger start about the GDP number. In fact, just now you also mentioned the reflation. I guess we are seeing the inflation is getting higher. So this is something China want to see, right? But of course, this may not be the good quality of the reflation that China want to see, because this is a cost pushed reflation, and technically, it's kind of the wealth transfer from onshore China to the offshore oil sellers, right? So I think this may not be the good quality. But again, reflation is a reflation. So it may potentially help reset the inflation expectation in the near term. So that may potentially delay the urgency for China to roll out any short-term stimulus, in particular like an interest rate cut or reserve requirement ratio cut. But in my view, I still keep the forecast. I think they may still have one-time interest rate cut, partially because I think the NIM, which is the net interest margin in the Chinese banking sector, is kind of stabilized. In particular, we are seeing a lot of repricing of the deposit right now in China to the lower interest rate, so which gave quite a nice pickup for the NIM in the banking sector. If the NIM can stabilize, I believe there is still the room for China to ease more in the coming months. But of course, that may be potentially delayed from the first half to the second half of the year.
All right, Tommy, thank you for joining us this morning. Tommy Xie, the head of macro research at OCBC Bank.